Hello, everyone. Welcome to the weekly roundup. Today, we'll cover growth, job numbers, and market recap. Hello, Ben.
Hi, Eva.
Happy Friday.
Happy Friday. It's like the old days. We're recording on Fridays again. Just this week. Just this week.
Just this week. Okay, so I'm going to start with growth. Canada has now seen back-to-back quarterly contractions, putting our economy in a technical recession. What does this say about the health of the Canadian economy, and is there a case for rate cuts now?
That's a great place to start. I like that the economists of the world continue to change the data as much as they want and whenever they want.
Units.
And exactly, a technical recession. Yeah, that's a good one. Yeah, that seems to be the story of the day, though. And so yesterday, or the last couple of days, as you know, we've talked about, I spent the last couple of days in Montreal, and the last speaker of the day yesterday was Stefan Marion, who's our chief economist. And that was part of his presentation, of course, is that yes, we're in a technical recession. His view was it's probably not going to continue. I guess my view of being in a recession is that's where we've been. Like we've been in a difficult market for the last 6 months. And so that would be more my view is we're in a recession. I think what happens from here will be really contingent on what the government does, what the Bank of Canada does, to your point, which I'll comment on, and then of course what happens in the Middle East. And so we are in a recession, and is there a case for rate cuts? I mean, this each time the global economy slows, each time Canadian economy slows, is that what's the reason? And so oftentimes it's demand led, where the consumer just stops spending because of many things. I think Canada's in a position where the consumer can not really stop spending because most of the money is being spent on things that people need every day. And so I don't think we're going to see demand destruction, but it's more on the supply side is what's scaring all these central bankers and everyone around the world is this stagflation term, which is growth slowing and inflation's increasing. So that puts the central bankers in a bit of a box here where they are in a difficult point of do they cut rates, do they not cut rates? Based on the jobs numbers from Canada this morning, it's unlikely that we see any rate cuts. I mean, the rate market didn't move much off of the news, and so right now we're talking about no cuts or increases until Q1 of next year. So I would lean up with that still right now. If the economy continues to deteriorate and gets worse because the conflict in the Middle East goes on longer, then I'd say there'd be a case for cuts. But at this point, I'd say not yet, just that no increases.
Okay. Just
Yeah.
a little more on the job numbers. How is this data going to impact, macroeconomic variables? What did the data tell us?
So Canadian job numbers are terrible. Like not from a perspective of they're good or bad, it's just how they're reported. It's so
Mm.
choppy. We get so much noise as we miss and hit at huge wide margins, some of the worst in the world. So the Canadian jobs forecasting is quite bad. On the Canadian or on the US side, it was much more in line with expected. So I think the US really nothing to see there. That's probably good news for Warsh, because his first meeting will be coming up later this month, but nothing much there. In Canada, I think not much. Continue to see weakness in the Canadian economy. A lot of the jobs end up being part-time jobs, not like high quality, high paying ones. So my read through of the numbers this morning is that yeah, we're not in a robust environment right now.
Yeah. To wrap up, how about a quick recap of how markets performed in May and what investors should be watching in June, even as we head into the quarter end?
So the markets were good in May, and if the market's signaling anything to us today, they're saying we should have sold at the end of May and gone to the beach. So I have a bit of a correction here in the last couple of days. But honestly, I think yeah, we had a good month in May. Some serious overextensions as we've talked about. Some of these names, if we owned Micron, we're totally out of that position over 1,000. And some of those big tech names that ran up like crazy are starting to come under pressure. So as we, I think, head towards end of June, end of quarter, it'll be interesting to see what happens. Listening to many people speak the last couple of days, it's, it's this interesting view that, yeah, I think long term there's a big need for energy, there's a big need for tech and AI and innovation and robotics, but maybe stock prices have gotten ahead of themselves to your point around that question. So um, I think that's the case as I think we've talked about this now for a couple of months. As said, we're in some sort of a bubble. I think the question is how high does it go and how high does it move from here? This is the first time in a very long time that we're seeing some selling pressure. And if you probably read the headlines, I think I said it's the worst day on the Nasdaq for 8 months or something silly like that. Next couple of weeks we're going to get a better picture. But at least so far the market isn't broken. And But you need to be conscious of where we're at. And a day like today where selling's coming in, the only things going up are consumer staples. A US dollar, of course, goes up when the market corrects because hedge funds have to delever their risk. But consumer staples, so some of that money flowing in there, that'll be worthwhile watching because those names like Conagra and Hormel and Coke and some of them Colgate, some of those defensive names are up today. So they're cheap, more attractive. Some money's starting to rotate into there. So I think that'll be worth watching.
Yeah, I see the charts.
All right, as I mentioned, we are recording this around 2 o'clock on June 5th. So anything that happens between now and next week at this time, we'll comment on. But we are going to jump into this one. So this is the one that you hit off the top. Canada GDP is concerning, but the R word is premature. Well, that's what our economics team said. Look, I mean, depends what you think of recessions. They're two negative quarters, so I would say yes, we're technically in one. I guess the argument that they make here is that the trend is still higher on a GDP perspective. Even a per capita GDP is moving upwards. I think is their view around why things are a little bit more optimistic. As we look ahead of what happens from here, at least from a Canada point of view, is Carney has put forth a lot of reasonable suggestions, and now from here we have to see if he can execute and implement those. And so I think it's going to be an important time because Canada, they're looking at putting in data centers. They have, a lot of natural gas, lots of natural resources. The only way Canada is a leader from this point is if we choose to pay attention and put, some policies in place that are going to help Canada, I don't want to say exploit, but help Canada use what they have to succeed from here. The one thing that we've done is we've completely hollowed out our manufacturing sector. So we've been in a manufacturing recession for, I don't know, something like 12 to 14 months in Canada. So at this point, we can choose to maybe spruce up the manufacturing, but from an immediate term perspective, we need to really take advantage of some of the things that we're strong at, and energy, natural resources is the key one. And so we'll see if Carney's able to execute. And if he is, then I think this chart says, we continue to move higher in a positive direction. If it doesn't, then we move more to the other, which is things could deepen at that point. And then we'd have to look at, potential rate cuts and stimulus to support the economy. So this is the next one is perspective on government bond yields. Everyone interprets charts differently, but my view on this one is if we look at the darker line, this is US yields. And so this would be the 10-year yield. So right now you look at the The US government, they're somewhere around 4.5% on their 10-year bond. The Canadian government is somewhere around 3.5% on that 10-year bond, so 100 basis points, 1%. It's quite wide. And there is a couple of rationales around why you may think why this is happening. And one of them is there has been a lot of foreign demand for our bonds. And so right now, something like 40% of all outstanding government of Canada debt is owned by foreigners. So it's the highest level that we've ever seen. And that's been a rotate out of risk and their discomfort with US treasuries right now. And so US treasury yields are quite a bit higher. In fact, the governments of Canada, both provincially and federally, they've started to issue US denominated debt because there's plenty of buyers that still want to own US dollars but don't want to own US treasuries. And so you've seen a lot of attention and support for the Canadian bond market and the Canadian dollar. So that's government bonds primarily. And so this is an opportunity and potentially a risk if it starts to move against us. So I think Carney has to be conscious of this. And I mean, his space is finance and economics, and I'm sure he's well aware of this. So lots to pay attention to. But this is like a pretty wide divergence that doesn't happen very often, and something I think we need to think about from a perspective of the most pressing issue coming up is USMCA, which is Canadian US Mexico Free Trade Agreement, and that could go either way. If it lands in a positive direction and they come to an agreement and renegotiate something, then Canadian dollar, US dollar probably doesn't move much. Maybe Canadian dollar slightly strengthens. If President Trump decides to blow up that agreement, we probably have a big divergence there where Canadian dollar drops maybe another 3, 4, 5, 6 cents. US dollar accelerates. So I think this will be important chart to watch. Last chart here is from Brian Belsky and his team. So Brian was at BMO for a long time, gone off on his own, started his own hedge fund, excuse me, investment fund and research firm. This was a great chart. I did put out a different, slightly different version of this in one of the dailies the other day. And I think it's important to think about what do we do at this point? And Eva, you asked off the top, what happens with stocks? What, where do we go from here? I think this is a great call out to say maybe there's an opportunity to switch out of, something that's trading at $1,000 and buy a stock that's trading at $20. And, that may seem silly from a psychological perspective, but the research that Brian and his team has done has effectively shown that low price stocks actually historically perform much better in the current environment that we're in. And it doesn't necessarily mean small companies. If you look at the breakdown here on the left-hand side, number of stocks in the low price screen based on market cap. So these are still big businesses. So 12, less than 10 billion, 21, 10 to 25 billion, 11, 25 to 50 billion, and then greater than 50 billion. So these are still big businesses, but at low prices. And so it gives you a diverse chance to look at where are some of these stocks that present some opportunities. We talked about this here. Consumer staples are doing well. That makes sense, like the Conagras of the world. So I think this is an area where I'd be looking for some potential switches to, take advantage of some nice gains that we've had and switch into maybe some lower priced stocks that offer good risk reward, given the fact that I think markets are a little bit overextended. As always, the opinions expressed in here do not necessarily reflect those in National Bank Financial. Everyone's risk tolerance is different and unique. Should you have any questions around anything we spoke about or the investments in general, please feel free to reach out to Eva or I, and we're happy to give you some context and see if anything is appropriate for you.
Thank you, Ben.
Welcome.
What are we focusing on next week?
So after really what the market's doing now, which is a little bit of a correction, is to see if we get some follow through on that. So I'd say that'd be a big thing. Say all things being equal, nothing happens, no settlement in the Middle East, then I'd say does this market fall through to the downside? And if it does, then we're probably going to get some reasonable buying opportunities in short order. Next week, we'll see if SpaceX goes public. I think it seems like it's on tap for that right now. It says June 12th, which would be next Friday. So I think when I started thinking about this 2 years ago, I'd said my one of my biggest fears that SpaceX marks the top of the market. So I would be quite concerned about that and something I'd be paying attention to. It'll be worth watching what happens coming out of there because one of the agreements that Musk made is that after the second trading day, all of those private shares, people are allowed to sell 20% of their private holdings. And typically it's a 6-month hold, but this particular issue is going to allow insiders and individuals to sell on kind of day 2 or 3, which would be the following Monday or Tuesday. So that's going to be important to watch. And then from a Canadian perspective, there's a generic drug company called Apotex going public next week as well. So that'll be important to watch to see how it flows through. And then on the other side of that, we more like Anthropic and OpenAI have considered going public. So, I think these are real important pieces to see what the health of that AI tech, how that's going to flow through. Can the market absorb that? So I'd say those will be really market specific things to pay attention to. And then obviously the geopolitical overhang continues.
Okay, great. Thank you. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and in your email box. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you for listening and have a great weekend.
Thanks, everybody. Bye.
Bye.